When people think of accounting, they often think of math, they think of numbers. But we will see that accounting is really much more akin to a language. It is said to be the language of business. The primary function of accounting is to measure the activities of a company and communicate those measurements to interested parties. Emphasis on communicating. So what things are we going to measure and communicate? What will we account for? In Solid Footing Chapters 1 and 2, which is Spiceland Chapter 1, we're introduced to the fundamental accounting equation. Our stuff is equal to claims to stuff. Stuff are the resources that a company owns that will provide a future economic benefit. In accounting terms, we refer to these items as assets. Assets, for example, include cash, inventory, land, buildings, and equipment, and can also include something called accounts receivable. Accounts receivable represent future claims to cash. We may provide services or sell products to a customer on account, and they will owe us payment in the future. On the right-hand side of the accounting equation, we examine how we got this stuff. Who has claims to the assets? Liabilities are non-owners' claims against assets. Accounts payable arise when we purchase services or goods on account. That is, we pay for them on credit. We've acquired an asset, but we have an obligation to pay for it. Other examples include loans from banks, where we get cash but have an obligation to pay it back, and obligations to employees, landlords, and others who have provided us assets of value. Owner's equity represent claims that we as owners have to assets. In other words, it's what's left over after satisfying our liabilities. Let's examine two cases to illustrate this point. Imagine you want to begin a business providing lawn mowing services. In case 1, let's assume you own the lawnmower and you contribute it to the business. Let's assume the mower has an asset value of $300. You have no liabilities and you have owner's equity of $300. That is, the business owns the lawnmower outright. In case 2, however, let's assume you don't have a lawnmower to contribute to the business. You need to get a mower, so you go buy the same mower that we examined in case 1, but you have an obligation because you buy the mower from a merchant on credit. You have an obligation to pay for that mower. You do not have any equity in the business. In each case, the assets are the same, but the distinction lies between who has claim against that asset. In the first case, you owned the mower and contributed it to the business. You as owner have claim to this asset value. In case 2, however, you did not have anything of value to contribute to the business. You had to go to the merchant and ask for the lawnmower with a promise to pay for it in the future. We will keep track of each specific asset, liability, or component of equity in what is called a T account. T account gets its name because of that shape. We will draw a T, and we will list the name of account, and we will use terms debit and credit to explain increases or decreases in the account. The general ledger is where we will house all of these T accounts. Imagine a book which summarizes each of our different accounts: asset accounts, liability accounts, and equity accounts. Back to the accounting lingo I just introduced, debits and credits. Debit simply means left, the left-hand side of the T account, and credit simply means right, the right-hand side of the T account. The interpretation of that, however, is what's most important. The rules for determining what a debit or credit means differs depending on whether we're on the left-hand or right-hand side of the fundamental accounting equation. On the left, we list our assets. Assets are increased by debits and decreased by credits. Notice, however, on the right-hand side, the interpretation differs. Debits mean decreases in liability or equity accounts, and credits increases, just the opposite of what we saw on the left-hand side of the fundamental accounting equation. These rules are critically important, and you need to memorize them. For every transaction that we examine, we will record what's called a journal entry. Debits must equal credits when we do that in order to keep the fundamental accounting equation in balance. We will record the transactions as they occur in what's called the general journal. The general journal is where we record transactions using debits and credits, and we do that in chronological order. The format for recording a transaction in the general journal is to first record the debit, we'll provide the account name and the amount of the transaction. Second, we will indent and record the credit, listing the account name and the dollar amount of the credit. Remember, debits must equal credits. In summary, debit first, credit second, and indented to the right. Here are two examples. After we've recorded these in the general journal, which you can imagine as a book, we will now post them to the T accounts in the general ledger. We will have our mower, cash, our owner's equity, and our payable. Notice that debits equal credits and our fundamental accounting equation stays in balance. We have $500 of assets, we have a $200 liability, and we have $300 of owner's equity. After we've posted to the T accounts in the general ledger, we can prepare a trial balance. A trial balance simply lists each account name and the ending balance for each account. This allows us to ensure that our debits equal our credits. We can then use the trial balance as the source for preparing the financial statements. The first financial statement that we examine is the balance sheet. A balance sheet summarizes the fundamental accounting equation on a particular date. For example, as of the end of the year. Using the two journal entries we just examined, our simple balance sheet would be cash, 200, our mower, 300. We would have total assets of 500. We would summarize our liabilities. We have the payable to the bank. We have our equity, simple owner's equity of 300, and we would total our liabilities plus equity to be 500. In Solid Footing Chapter 2, we're introduced to a variety of assumptions that underlie our generally accepted accounting principles. The period of time assumption states that we can prepare financials for any period of time that we desire. We can complete the accounting cycle on a weekly basis, a monthly basis, a quarterly, or even an annual basis. In Solid Footing, we begin by examining monthly periods. The entity assumption clarifies that we will do accounting for just one entity at a time. Every transaction will involve two entities, one party and a counterparty to the transaction. We will pick one side and do the accounting for just that side. The monetary unit assumption states that we will record economic events only if they can be specified in monetary terms. If a company hires an employee, that's an important economic event, but we can't quantify the employee's value in dollars, and therefore will not record the transaction. The going concern assumption specifies that we assume companies will be in business for future periods. That's what makes inventory an asset. If we acquire inventory, it's a benefit to the company in future periods only if we can sell it. The going concern assumption states that we assume companies will be around in the future to sell that inventory. The cost principle states that we will record assets, such as inventory, at the amount we pay for them. The inventory we acquire, certainly we hope we will sell for a higher price. We don't speculate on what that price will be, and we don't try to determine whether or not we acquired the inventory by getting a good deal or having paid too much. We simply record it at its cost. Finally, the accrual basis assumption states that we will record transactions in the period in which they are incurred, even if the cash is not yet involved.